All right, I'm done with the announcements. We can get started with the conversation. I'm really happy today with the panel that we have lined up to discuss funding in the fintech sector. We have represented tonight the VC sector, corporate venture, as well as the startup founder perspective. So I'm really excited to introduce to you Laviva Mazar, principal at Luge, Philippe Daou, Vice President, Managing Director, NA Ventures at National Bank, Annick Charbonneau, who is a technology entrepreneur, co-founder and managing partner at Excelia, and Xavier Freeman, co-founder and CEO of USET.
Are we going to just alternate
genders?
Or rather, let's put a woman in the center.
So we have a lot of questions prepared, but this is a great panel. I'm really excited. I had a great prep with them. So let's see how much ground we can get covered in this little short period of time. For those of you, we'll have a short Q&A period again. People online as well. We have our team monitoring the chat, so you'll get a chance to ask questions as well. So my dear panelists, if you can please introduce yourself and a little bit about you in just 1 minute each for our audience, please. Starting with you, Xavier.
All right, does this work? Can you guys hear me?
Yeah.
Cool. Xavier Freeman, co-founder of USET. So we're basically an insurtech startup. We automate the insurance shopping for home and auto insurance. So if you guys have your home or auto insurance coming up, check us out, uset.ca. Takes 4 minutes to complete a quote. We connect in real time to a bunch of different insurance companies, and we show you the best offer we found in the market. We've been used by over 75,000 people since we've launched, and we have a 4.9 star average review. And at this point, it's no longer my family and friends who are reviewing the company online. That's it. I'll try today really to give more the founder perspective. From where we started to where we are today, we've raised pretty much everything, including loans, grants, tax credits, angel investor money, but we haven't gotten to the VC or corporate VC stage yet. So I think it's going to be a very complementary flow of discussion.
Wonderful. Thank you. Annick?
Yes, hi, I'm Annick Charbonneau, co-founder and managing partner at Excelia Capital. I was a tech entrepreneur for 10 years. So I was in your shoes for a long time until I switched to the dark force of things and became a VC. And what got me into the VC space is that I witnessed firsthand how hard it is for women to raise capital. And so Excelia Capital invests in innovative companies owned or led by women. And we closed a $54 million fund in December. This is our year one. We're one of the largest funds to propel female entrepreneurship in North America.
Oh, congrats, Annick. That's great news. Philippe?
Yeah, so Philippe Daou, head of NA Ventures, a fund that was started by National Bank 4 years ago. We deployed 80 million in around 25 odds companies. The goal of a corporate venture is really to go and find strategic partnership for the bank, help the bank accelerate its transformation, grow its revenue, and so on. And so we work with more than 90% of the company we invested in. So we don't only talk that we're going to be a strategic partner, we also deliver the talk on that. Before that, I was in consulting for 15 years at one of those in the bank.
Hi, I'm Laviva. So I'm a principal at Luge Capital. We're a fintech-focused venture capital firm. We launched in 2018 with $85 million and backed by 7 financial institutions, including a couple of strategic ones. So Desjardins, Sun Life Financial, Industrial Alliance, and Beneva are basically financial institution backers. And we work very closely with their innovation team. So much like with Phil, with NA National Bank, we get similar kind of feedback and working relationship with the innovation teams of the LPs that have backed us. We invest in seed and Series A startups in fintech across Canada and US. So I've been with the firm pretty much from day one, joined as an analyst when the 2 co-founders were basically launching the fund. Before that, I was at another firm where we were actually building a couple of fintech startups ourselves. So I kind of worked alongside the founders and also did some investments from the venture side.
Thank you so much. Yeah, I told you, a great panel of experts lined up tonight. So we've heard a lot about the drastic changes in funding, and especially in the last year. So lots of money that was poured, crazy valuations, and also, should we call it the great melting of valuations in fintech? Possibly. There's a recent report by CB Insight that found that the funding that was injected into Canadian fintech companies in Q2 dropped by 75% quarter over quarter. So from $1.2 billion to $300 million. So significantly down, even this year alone. Maybe Laviva, I can start with you. What's your perspective on why is there such a drop in the investments?
Yeah, so I have a lot of points here, but I'll start by saying that actually, if you look at the report in detail, it's not just Canada that received the brunt of fall in fintech funding between Q1 and Q2. It's actually, I think, other than Africa, all the major regions that they were covering, everywhere fintech funding kind of went down between the 2 quarters. There's a lot at play. Obviously, the public markets started taking a downturn at the beginning of the year. So I think that impact kind of trickled down into technology stocks and also private technology companies as well. Definitely at the later stages, I think there was a lot of further funding slowdown compared to the early stages. I mean, feel free to chime into that. But I think overall, it's not just Canada and it's not just fintech. Like I think there's a funding slowdown overall in any technology companies, at both in the public sectors, and that's definitely trickled into the private sector as well.
As soon as we say there's been less investment, people assume that the funds wanted to invest less. But the good companies have money in their bank account and are not on the market for a raise.
Exactly.
So even if me, Laviva, and others wanted to put money in, there's no company to put the money in. So it's a double effect that we're having here. Company that have to raise in this downturns usually are less good companies, especially if they have to raise very early in the downturn because they didn't see it coming.
I'd say though, for example, there were a lot of big rounds last year. So if last year was in my opinion, it was a bit, it was a bit of an anomaly because a lot of companies were raising, I've seen seed rounds at $15 million. Like the funding amount, not the valuation.
Wow, we really missed our shot.
Or Series A rounds that were 50 million or 30 million at, sometimes pre-revenue companies raising at $100 million valuation. So as Phil was saying, a lot of these companies are already well capitalized. So they're not in market raising big rounds right now. I'm seeing a lot of companies that are raising internal extension rounds or maybe opening it up to a couple of VCs that they have relationships with, but mostly kind of driven by internal investors already. So that's probably also why the rounds themselves are also a bit smaller. And then, like I said, there's definitely slowdown in terms of like a bigger slowdown in the later stage funding. So you're not seeing as many mega deals as I guess we saw last year. So I don't know. I think it's just par for the course. I think that's how the market works over a 10-year period. So I don't think it's like all bloodbath and grim. I think it's gonna turn around.
So essentially, are we simply just going back to pre-pandemic kind of level of activity? All of you feel free to answer.
I wouldn't say so. I think I'll be grimmer than my friend here just for the fun of it. And probably the round that you saw are actually round that just didn't close in Q1 or until last year.
That's the other thing.
And you're just trickling down, so it's even worse than what you see. But it's not all dramatic. The good companies are still raising.
Yeah.
The good IDs are still raising. No, you're not going to raise at 15, 20x like we saw in 2021. But as Laviva was saying, the true outlier is not 2022, it's 2021 that was acting crazy. Valuation were just off the roof. They made no sense. So now that we're getting towards something that is investor friendly, rather than something that was founder friendly in 2021, I think that as we go into 2023, 2024, it's going to rebalance itself between founder friendly and fund friendly.
I'm gonna quote a colleague from Zig Capital who said, if 2021 was a party, 2022 is a hangover.
Well, Xavier, what's your perspective on that? You were able to raise some funding this year. Were you impacted by that at all?
Yeah, no, I can echo to what everyone has been saying. Yeah, on our side, to be very transparent, we raised a round in December 2021. So I was part of the party. We decided just to announce it a couple of weeks ago, as it was a better timing for us. But I would say to any entrepreneur here, like, don't freak out. Like, if the timing is right for your company, just do it. Because in December, I could have told myself, I'll wait another 3 months before raising, because we'll have better metrics, we'll be more advanced in our product development and customer adoption. And then what is happening this year would be March, and then it would not be a good situation for you. So if the time is right for the company, go ahead and do it. You're probably just going to have more attention from VCs or investors now that there's a little bit less deal flow. So I'm trying to see like the positive side of things for entrepreneurs here, and I wouldn't see the current market dynamics as being a slowdown for you. Like you should still go ahead and move forward with your funding. That's my opinion. Yeah.
I appreciate that. That's the spirit, entrepreneurs. I want to touch a little bit on the valuations. We saw highly inflated valuation that highly deflated as well this year. How is this impacting maybe your decision making right now and the ecosystem as a whole? The fintech, and how is it impacting the fintech ecosystem from your perspective?
I think it's valuations getting reset to levels that are tolerable to a lot of people. I think that for us last year, we tried really hard to make sure that we're being prudent with the prices that we were paying. And we continue to do that, just always looking at, the growth of the company, the metrics of the company, and the runway, and whether they can, even if it's a relatively higher valuation, can they grow into that valuation by the next stage of funding? So I think, if you look at the crazy multiples that we saw last year, we're not seeing those. But another dynamic to that is that because the rounds last year were so big, like you cannot raise $20 million at a $40 million valuation. You're going to lose a big chunk of the company, right? So I think part of the reason why I think the valuations were really high, the market was very competitive. There's a lot of capital, cheap capital, but also, they were raising mega rounds. And so the valuation had to be high to make sure that the founders aren't massively diluted. So now we're seeing lower amounts being raised. I've seen some founders that, maybe at the beginning of the year tried raising $10 million, came back and now are saying, oh, we actually want to raise $5 million because that's what we think we need until the next meaningful milestone. And so the valuations, although you don't want to pay just based on dilution, but that is a factor that plays into it as well. So valuations are, a little bit more tempered than last year for sure.
Yeah.
I think we're putting too much importance on valuation. Like what people should be looking for is the right partners. Which funds are going to enable them to go further and grow faster? In the case of corporate venture, can you work with a strategic to increase the size of your business, etc.? And when you find a big partner, I always say 100% of 1 million is still less than 10% of 100. So find the right partners, find the right money for you to continue building the business, and make sure that that allows you to go forward, not running after valuation.
Yeah, I'll ditto that. At Accelerate Capital, we always say we go beyond the check. We start with a check because founders need money if they want to scale globally. But we at Accelia, we've created an ecosystem of 20 or so top business women who not only are LPs and investors in our fund, but who also help out our portfolio companies. And we're talking big names, and I'm just going to name a few, like Monique Leroux, who used to head Mouvement Desjardins, who's today a strategic advisor at Fiera Capital. We have Marie-Josée Lamotte, who used to head both Google and L'Oréal Canada. We have Melanie Dunn, who heads Agence Cassette. And so this is what we offer to our companies in portfolio. And so I understand, because I've been in your shoes, how much it's your baby and you don't want to let it go and you want to raise the big dollars because it makes you look good. But at the end of the day, once you go through multiple rounds, you'll see that the quality of the people you have around you who enable you to get to that next level, whether it be in key performance indicators or next valuation or whatever makes your company grow, then you'll find that the issue with valuation, especially if you're early stage, doesn't really matter. It'll matter later on for sure, but just be reasonable, get the right partners to fulfill SEC on it.
And for you, Xavier, I know this was also very important as part of your decision making and raising funding.
Yeah, I would say like you're at this point, if you've already onboarded funders, and once again, I'll just want to throw it out there. There's other funding than VC money. Like we're gonna celebrate our 5-year anniversary next month. We raised a 2.1 million round December of last year. That was 4 years of work where we didn't have access to massive amount of capital, and you're still able to go through and build a business. If we're lucky enough to secure funding prior to the current market situation, it's just a good opportunity for you to get tighter bonds with your current funders. And I'm not just talking about investors, it can be loan grants. There's a bunch of different people that can help you get to a stage where you're appealing to VCs. If you're in a current market downturn, take the current funders and backers that you have and try to see how you can enhance the relationship with them, and if they can back you some more, because they know you, they trust you, they're seeing that you can deliver. And I would go towards that instead of trying to always chase for something bigger. That's another option also that's open to you. Yeah.
Thank you. During our calls, we were talking about, I'm staying a little bit on the valuation topic. We're talking, I remember you had a great perspective on the public companies, and I think maybe this is what inhabit the imaginary of people. This is what has the greatest impact. And we also touched on InsurTech being highly impacted, maybe more than the other fintech verticals. Philip, I want to hear you a little bit more on that, the valuation part for the big publicly known companies, and then I want to go to you after Xavier to understand a little bit how, or if at all, this has impacted you in your sector.
So if you look at public companies, they went down by 70 to 80%. But most public companies that are out there in terms of fintechs are lending companies. And when you look at lending, those lending companies, they're lending to subprime customers. They're lending to people banks don't want to lend to. You're about to go into downturns. So investors are expecting those companies to be ramping up massive amount of default. And those companies don't have a balance sheet like banks have to absorb those default. And we've already saw companies that were in lending starting to fall. And the valuation in the market is reflecting exactly that. Those market valuations are falling. The other type of company that have that market valuation falling that were public are Robin and Wealthsimple. And those companies, Wealthsimple is not public, but because of their ownership, we know when people are taking write-downs. They were heavily in crypto. They were trading a lot of crypto, and we're in a crypto winter. So yeah, valuation went down because the number of operations is going down. So those are the two main type of fintech companies we have on the public market. And then everybody's looking at fintech and saying, oh, we should decrease all the fintech valuation by 60, 70, 80%. Makes no sense. They're not in the same domain. B2B is not as impacted by valuation decrease or by revenue bled than those companies are. And those B2B companies were a bit shot during the 2021 era. They're not the one that were able to raise a crazy valuation because all the actors in the market were trying to revamp their client experience so that their clients can do internet banking. But now that this is gone, banks and so on are going to try to reduce costs, and that's highly done through B2B. Those companies are going to have great days in front of them. So public market is only a snapshot of a few companies. Now, I know nothing about InsurTech.
Yeah, Xavier, I was wondering, in your sector specifically, like how's it impacting you?
Okay, so I'll try to not get too technical, but so who here knows about InsurTech? Can you raise your hand? Okay, who's excited about InsurTech? Can you raise your hand? Okay, that's good. Not too bad. So yeah, just if we what happens with big general idea about insurance is that you're technically collecting money from a customer in exchange for money when something bad happens to them in the future. So that's what, like, explain to me like I'm private insurance. That's the way it works. So when you're aggressively growing your business through external funding rounds, for example, and you're a startup, you're mostly focused on customer acquisition. So you're collecting money from new customers, and you're spending a lot of money to acquire those customers so that they can, share money with you. What happens later on is that at some point they're going to have to claim because something bad's going to happen. And then depending on how you structured your company, you might end up in a situation where you took a lot of funds to acquire those customers, and now you're in a situation where you actually have to pay more money to these customers than what they've given you in the past. And that's the loss ratio topic within insurance. So that's something that you don't know, because when you're a 1-year-old company, you probably have very little claims. They're coming year 2, 3, 4, 5, and 6. So that's kind of when there's a big party, for example, a lot of money being spent on customer acquisition, it's really hard to predict what the future losses will be. And if your engine is not built correctly, it can be very disastrous, or you can see, not so good results. So that's kind of the InsurTech part on my side that I can explain to you. Yeah.
Yeah, and just to chime in, some of the insurtech companies that grew very fast and went public, their metrics weren't properly in place, and you can very easily compare them to your traditional insurance carriers. And you look at the metrics and you're like, oh, I mean, why should I pay for a really crappy book of business, even if it's a sexy insurtech company, versus buying the stock of a public company that is, doing financially well and is, stable. So I think that's why insurtech stocks actually took a bigger beating in the public markets again. But you're spot on about the growth on, with some of these OG insurtech companies, they spent a lot on growth and didn't focus as much on the loss ratios. But some of the newer companies that we're seeing now at your stage or a little bit further along, that they're now focusing a lot more on the profitability, and reinsurers want that as well.
Thank you for that, Liva. Okay, so we've talked about the challenges of the market and things resetting. Can you talk a bit more, maybe more from a fund perspective? What's the attitude of fund in an environment like this? Are you writing same number of checks at smaller value? Are you more conservative in your investments? What's the attitude that funders are taking in an environment like this?
Good companies will always get funded. So if you have a good product, a good team, a good business plan, and that you have some traction, even in a tougher market to raise, good companies will get funded. But the difference is now, because there's a slowdown in the amount of deals that are being made, the investors are much more rigorous in due diligence process, I would say. And so we're much more acute to being oversold. It's one thing to paint a good picture of what you're doing and being ambitious and, wanting to conquer the world. It's a different thing to present numbers or KPIs that aren't quite exact. And the thing is that investors, we do our diligence, and then we look under the hood, and if your claims don't match what we're seeing under the hood, then the confidence in the relationship goes sour very, very quickly, and chances are we won't be writing a check. And so that's what I've witnessed from my side. I'd be interested to hear what you guys have to say.
I feel like it really depends on where you are as a fund as well.
Yeah.
We're still looking to invest. We're definitely, the thing is we've always been selective, so I can't say that we're being extra selective in this environment. I think every fund has their tolerance in terms of how much risk they want to take and what price they want to pay for that and so on. If you're sitting on a lot of dry powder, maybe it's a good opportunity now to, invest in companies you really like and maybe come into some of those extension rounds or, back companies that you've been tracking for a while at relatively good, better valuations than last year, like I said. But if you're a fund that's, out of money, it's very different. So yeah, I don't know, Phil, what do you think?
I've invested way more this year than last. So this is a great environment for investors. And if you were patient in 20 and 21, then you've got a dry powder to invest now. And when I invest, I have way less competition in the investment round. So there's bigger place for us. If you were trying to do 2021, we were like, everybody was fighting to get 1 million out of 5, and then you ended up with a few investors. Now it's much easier to get the level of investment you want to have in the company, and then to have the level of implication you want to make the company go further. So for me, we're strategic funds. So we're looking at a strategic value for National Bank, and then if it makes sense, we invest. But if the valuation is too high, I'm sure the company will still want to work with National Bank even if I don't invest. So I'm playing the long game, and right now is a great time to be putting money in companies.
And echoing Anik's thoughts as well, the best companies are still raising. I mean, even some of the companies that we're seeing, really good companies, there's competition and people are not being able to get in. So,
Yeah.
Okay, good. So it's a funder's market, take note, people.
unlike last year.
Like last year. But it brings me to another question. I'm going to make a logical link here to the Canadian conservatism when it comes to investment. So it's often we hear, oh, go to the US, it's easier to get money. Maybe, I don't know if the due diligence is not as stringent in the States. Maybe there's just, they buy into more fluff, or what's the comparison in the investment attitude here, for example, and the US, and also if you have a global perspective, maybe we do better investments? Are we losing companies to the US?
Well, I think that right now our conservative approach, if we look at it as a Canadian whole, is it pays off for us, right? Because when there's upswings, maybe we don't go up as much, but when there's downswings, we also don't go down as much. And I could say that for the Canadian economy as a whole. And so I think that maybe that conservatism makes us both better founders, which are you now, and makes us both also investors in a market like right now. And like my colleagues have said, the funds that do have dry powder will be investing in really, really good companies right now that can get through sort of this investing rut.
I don't want to say that the banking ecosystem in Canada is an oligopoly, but let's say it's very
Hypothetically speaking. Would you like me to say it for you?
So because we're very concentrated, there's less clients for the potential fintechs in Canada, at least on the B2B side. There's also a lot less rich people in Canada to invest in fund. There's less family office. There's less a lot of things than the US. So the US generate more money, have a bigger market to generate companies. So the US ecosystem is always going to be more vibrant than the Canadian ecosystem, just by how we're set up. Just remember, California and Texas has a bigger economy, each by themselves than Canada. So we're not going to reinvent the wheel or reinvent the entire ecosystem of Canada. We are weaker. Now, we had government in the past that were, let's say, more investor friendly. And that's what we need to foster in Canada, is to have this system in place so that we are founder friendly and funds friendly. And I'm not sure we have that in Canada as much as in the US.
No, we're going to take a little water break. Sorry. All these great comments will make you thirsty.
So I totally echo what Phil was saying, is that the Canadian market is 1/10. I mean, I don't know in GDP numbers, but at least population-wise, it's 1/10, right?
Mm-hmm.
And for us, I feel that there's often this added extra layer of risk where, you are investing in a Canadian company. Either that company has to become a big standalone business in Canada, or you have to expand to another geography eventually, and that adds another level of execution risk that maybe the startups in the US that already started with a big market are not necessarily facing. I would say in the last 7 years, I've definitely seen a lot more funding activity going into the early stages than 7 years ago. I think, there are way more funds now. So I think the kind of like the sentiment is that the best companies will end up raising money. And for sure, personally, I've seen a lot more funds taking on risk at the earlier stages now than 7 years ago. Whether that's pre-product, pre-launch, or pre-revenue, there's funding happening in all of those stages as well.
And if I can add one thing, 7 years ago, 5 years ago when I started, the Americans fund didn't come to Canada.
Mm.
And now they've started coming to Canada.
Yeah.
But they don't understand the Canadian market. They treat Canada as the US, and they expect the company as having the same growth pattern as the US, who were a tenth of their population. The only sector where Canada is hitting above their weight is mortgages. Because we don't have 25 years mortgages, we have 5 years mortgages, so we keep renewing them, so the business is only 1/4 of what it is in the US. But those American funds don't understand Canada, and they give top valuation, like if they were in the US, and somehow you look at valuation, I'm sure you guys do as well. Yeah, this is crazy, that makes no sense, and there's no opportunity in the US for that.
Yeah, and not to generalize, but definitely if you raise money from US VCs, make sure you do your due diligence. I mean, we always ask whenever we're digging into a company, we want to do a deal, we always recommend that they talk to our portfolio companies, like choose whichever founder you want and ask them how it is to work with us, because I've actually seen this, and again, not to generalize, there's hundreds of VCs in the US, but I've seen situations where, a term sheet was written in 3 days, and then due diligence was very easy on, say, a later stage company. Person shows up at the board meeting and they have no idea what the business actually does or what their numbers actually look like. I've seen that a couple of times, and then when things take a downturn, and if you're not hitting your metrics properly, they might sometimes drop you like a hot potato because there's a lot more deals to be done in the US. And I'd say on the contrary, I've seen a lot of Canadian VCs kind of being there and holding your hand, doing everything they can, and making sure that you're being able to, like, doing every little bit that they can to make the company survive. So yeah, again, not to generalize, but that has happened.
No, but that's very important, and as a startup support organization, like, we get asked these kinds of questions, so I appreciate your feedback on this. And Nick, I want to go to you because I want to make sure we have enough time to highlight your fund. If you can please tell us a bit more about why did you start this fund? Which gap is it filling in the ecosystem supporting women in tech? And tell us about the great things you're doing about the fund.
Yeah, I'm afraid today's not too representative. How many have women founders or co-founders in the room? Raise your hands. Oh, good. One. Okay. 2. Awesome. So today in Quebec, it's 30% of new tech companies that are co-founded by at least one woman. And yet venture capital dollars are only allocated to women with 2.5% of the $130 billion that are injected into venture capital each year. And so us at Excelia Capital, we saw this as an opportunity. We said, okay, so there's the companies are there, but the money is not following. And when we started building the fund 2 years ago, Christine, my co-founder, and I, we got asked a lot the question, is there going to be enough women in technology to fund, right? And today that's our biggest and most pleasant surprise. We are crowded with good quality deal flow.
Okay.
And so we're in a position right now where, we have a certain cadence of investing, and unfortunately we have to say no to good businesses, but the businesses that we do decide to work with are just have amazing potential. And so even though it's a room full of men today, I'm going to throw something out to you guys. More and more institutional investors now are looking at ESG KPIs, okay, which means that if you're 5 white dudes, that are all engineers coming out of university and launching a business, your chances of raising capital are less than if you had a woman as a co-founder, a person of color, a person from the LGBTQ plus community, et cetera, because now funds, not just Excelia. I mean, at Excelia, it's part of our DNA to invest in women, but all the other funds now who are actually fundraising from institutional investors are getting the message that you guys better start investing in diversity, which is good for everybody, right? Because we don't have to prove this anymore. When there's diversity, there's just better results. And so for us, it's just natural to want to invest in diverse teams. But now I think other funds are starting to understand that and make it a priority, because that's what now the bigger economy demands, which is good news for everybody. It just means that there's going to be better performance with diversity and better results for everybody.
Any comments from my other, what's your experience with diversity? I mean, is it part of your investment decisions, or is that a metric that's hard-coded into the decision, or we're not there yet?
We track certain diversity metrics in deal flow from day one, like in our CRM. Also at the portfolio level, portfolio board, portfolio co-founders and management. We've, from the get-go, we've been a diverse team ourselves, and it's kind of in our DNA to be to be supportive of that. I wouldn't say it's a decision factor of saying, okay, this company has a female founder, so let's go and back them. I don't think that, plays that kind of a role. But for sure, we're always looking for, and personally for me as well, and I know the rest of my team, we're always looking for, whether it's female founders, we've got very good representation on the portfolio, on the kind of like background diversity side as well. So
Good job.
we have a long way to go still. I think the industry as a whole. But
I would just say that if we had done this panel 4 years ago, this would be for white men.
that is true. I'm
And
not
now,
just there.
we have two women.
Yeah.
It's the best way to get funding to women is to have women in funds. And I'm really happy to have two here. We've got one on our team as well, because that's how you do it. And you need to build a diverse team at the fund level, and they're going to invest in diversity as well.
Very good. Thank you.
Yeah, and I'll echo that also, because every once in a while I'll speak to, for example, a female founder, and they'll just say, it's so nice to be able to speak to a VC that's female because I just feel more comfortable. Or not saying that it sucks that they feel necessarily, more comfortable with a female VC, and I wish that they felt comfortable with others as well. But I think you're right that, it's good to have that on the VC side as well.
Amazing. Oh, you want to chime in?
Yeah, well, it's also like, don't do it. It's great that you have fun focusing on female founders. Like it makes a lot of sense, but don't get don't get a diverse team because it looks good for investors. Like do it because it's good. Like I started the company with Felipe, my co-founder. He's born in Brazil. Our first employee, Ariane. Shout out to Ariane. She's in the back there. She's been with us for 4 years. First software engineer that we hired. We were a 3-person team for a long time. And we wouldn't be where we are today if it was 3 times me or 3 times Ariane or 3 times Felipe. It's kind of the diversity that makes sense. So just do it because it makes sense for your business, and you're going to grow much faster if you have a diverse background of individual who think differently and can see different sides to the coin. And it there's not an excuse of we're a fintech company, we're an insurtech company. It's normal that we're 11 employees now. We have a majority of women on the team, and we're in the insurance space and in the tech space, which are predominantly led by men. So it's not that's not an excuse. You shouldn't use that. You should just strive to find the right people, and you're going to win in the long run for it. So that's kind of my take.
I love it. Thank you so much. Not a lot of time left. Lots of questions left. Okay, I'm gonna go to maybe the 3 funders. What are the top sectors you're looking at right now? What are you excited by? And also let us know, what are you not excited by? What are you tired of seeing?
Yeah.
So where's the money?
Sure. I think so. We have this we're looking at this slide internally a couple of weeks ago because we had our team offsite. But if you look at the public markets and the businesses or sectors like e-commerce or some other software-driven sectors, the tech enablers have kind of overtaken the incumbents. Whereas if you look at fintech, tech enablers are still a very, very small percentage of the financial services industry. It is still very much driven by incumbents. So I think overall, fintech-wise, we're yet to see a lot, I think, in the next, decade or so in terms of innovation and value creation and tech enablers taking more of that market share. as a fund at Luge, we look at everything within fintech. We've done, stuff in cybersecurity and payments, digital banking, insurance, obviously, crypto, DeFi. So I think in terms of one concept that I'm really excited about, especially for Fund 2, is the overlap of fintech with a lot of other really big verticals. So if you look at prop tech or healthcare and fintech is a big category in the US, especially, fintech and construction or, climate. I think there's a lot of interesting pockets of opportunities in those sectors that I think fintech 1.0 we didn't really explore as much, which was a lot more about digital banking, personal finance management, wealth management and things like that. So I'm excited by that overall, marriage of fintech with other verticals.
Thank you. Philip?
Yeah, I would agree with Laviva. I think embedded finance is going to be something that is going to go forward. I think that one mistake that embedded finance is doing at this point in time is that they're too much of finance and not enough embedded. And they're trying to become a bank inside what they're doing. This is not the goal of embedded finance. The goal of embedded finance is having finance embedded in your experience, but you need to remain your own company. So I'm excited about that. I think that in general, what we're seeing is a migration of talent from fintechs towards Web 3.0. Web 3.0 is something very large, but I think that with entrepreneurs migrating from fintechs toward Web 3.0, what we'll start having is Web 3.0 migrating from being that general ID that is pretty vague to actual solution that attacks problem like we saw with AI. No one is called that AI anymore because AI is finally resolving real problem. I think we'll see that in the next 3 to 5 years, Web 3.0 migrating toward that, and I think that is super interesting. What I don't look at, because that's also super interesting, I'm not a big fan of direct to B2C. Client acquisition costs are extremely high, and the company that succeed in fintech, especially in Canada, are going to be those that partners with incumbents, with existing institutions, and deploy on both ways. So extremely expensive to go B2C. Some are going to succeed, don't get me wrong. I think we're going to be at least one of the 2 neobanks we have today is going to succeed, and maybe a little startup around them, but they're extremely expensive and highly risky.
Thank you.
Well, at Excelia, we're sort of sector agnostic. So we invest in mostly women-owned and led companies. And so we always look for tech companies. That's our background, Christine and I. And so we've invested in digital health. Happier to report that we've invested in InsurTech, but with a very, very strong business with good KPIs. And we're looking at closing another deal now that I can't reveal. I'm still excited about artificial intelligence, and it might just be because I hold a certificate in AI from MIT. But I think that once you parse through what AI can actually accomplish beyond the hype, if you look at AI as a proper tool to create value within a company with an actual product and not just AI as a product, and we were discussing this earlier, I'm still very much excited about that. For me, there's not a sector per se that doesn't excite me. I get turned off when claims by a founder are not reflective of reality as of today. You can project what you want to do, but the picture you paint today, make sure it's a very clear and accurate picture, because then you're just unfortunately wasting the investor's time, and it's hard to make a good impression twice when the first one wasn't too good. So.
And just to kind of like loop into my final question, then prepare your questions, audience, because we're going to have a bit of time. We're saving a little bit of time for you guys at home as well. I'm going to ask all of you, starting with you, Xavier, what are your tips and tricks for startups that are trying to raise fund right now?
Okay, so I talked so I'll just give you kind of a recap. So there's different ways to get funding for your startup. There's grants, loans, tax credits, angel investors, VCs, usually in that that flow of state. But there's one thing even before that, which is generating revenue. And that's it.
Anik, did you want to add anything to your final bit?
Yeah, I mean, I actually love those kinds of entrepreneurs who've been through the ringer with all types of, no, I mean, we love to see from a founder that you're capable of creating value before you come to us. You know, VC money is tough to get. You know, out of 100 companies we'll look at, we'll fund maybe one. And then our demands on you are important. We expect you to be all in. We expect you to be growing fast. We expect you to be using our money wisely. Whereas angel investors will often be more patient with their money. They'll also be able to help in many other ways, get you started. And one of the big mistakes that companies make is to come to see us VCs too early. And then we have to turn you away. And we'll still look at you again in 6 months or 12 months, but maybe you could have saved yourself the effort and the time to actually work on your business properly and then come to us when you're actually ready. And so grants are great, it creates value. Angel investors are great, they create value. Loans are great because it means that you are willing to take the risk yourselves. And then, like Xavier said, if you have revenues, even better than come and see us.
Perfect, thank you.
I want to complete Xavier's list because I'm an accountant by trade. You need to control your expenses as well. And too often we see bubble expense.
Yeah.
I would say one thing when you come to see me, don't try to sell me the moon. You're not going to conquer the planet with your company in 3 years. It just doesn't exist. And too often I see those decks where they're in 3 years, they're bigger than Amazon and Apple, and they just conquer the planet because everybody was just sitting at home waiting for this to happen. This is not going to work. You're raising a fund, and it should bring you from point A to point B. This is what you're trying to sell your fund that are going to come at point A.
Thank you. Danva, closing words?
Yeah, on the train of finances, given the current market environment, I would definitely raise for not less than 18 months of runway. Ideally more, ideally 24 months, but that's super, super important because you don't want to raise and then run out of money in 12 months because then you're raising for another 6 months and 12 months is not necessarily enough time to hit your milestones. So that's, yeah, like super important. And then the other thing is fundraising to a big extent, it is also relationship driven. So for me, for example, we're not doing pre-seed investments right now, but I am still meeting pre-seed companies just as a way to build relationships. If we look at our portfolio of investments we've done, many of the investments we've done, we actually met the founders, say, a year or 2 years ago, built that relationship, tracked their progress, and felt like, okay, now we're ready to go in. So, yeah.
Wonderful, thank you so much. We have a couple minutes for some questions. Who has a question? Don't be shy. Everything was said? Oh, the beautiful man in the second row.
I'm curious about your biggest regrets. So I know you mentioned 1 out of 100 get funded. Like, is there any decisions that you wish you would have taken for all 3 of the funders, and even maybe for you, Xavier, things that you wish you would have done differently?
Oh, great question. He's my husband for those who want.
I can go first. I don't live in regrets because when you invest, you're going to hit home run, you're going to hit normal coup, and then you're going to have bad. That's all the investor have done. Someone tells you that they've got 100% hit rate and they only hit home run, he's just lying to you. So why live in regret? I've turned down a company that went very well. I'm super happy for it. And I was supportive up to the end to any of our company that also failed. So you have to accept that you're going to make a mistake.
So we've done an analysis of our anti-portfolio over the last 4.5 years to figure out, what was the reason for passing at the time, what were we not comfortable with, and ultimately what was the thing that led them to become our anti-portfolio, essentially. And I think the biggest thing that we realized was that it's the founder. I mean, we all know that already, but I think that was the one big trend that came out of that analysis was that when you had a good gut feeling about the founder, if there were still questions about, maybe the market size or the product itself, like, yeah, I mean, at the time, I think our reasonings for passing were correct.
Okay.
But at the end of the day, it comes down to the founder, and that was the biggest takeaway. So it's not really, I'm not saying a regret per se, but it was still interesting to look at our anti-portfolio, so I just wanted to share that.
Just want to put one word in what you said, gut feeling.
Yeah.
And that's why you
Yeah.
can't have regret, because it's not only about due diligence.
Oh, the gut is such a big thing in everything, because we've also had situations where, we'll start getting into negotiations or whatever, and you realize that maybe this is actually not going to be a good working relationship. And these are 10-year relationships, right? So harder than getting out of marriage sometimes, in many cases. So for real, guys. So do your due diligence, and if even from a founder's perspective, if your gut tells you that this is not the right investor to work with, maybe listen to it.
Okay, very good. I'm gonna jump to another question from online viewer. Jen from Finlity, it's one of the startups we support. Can you please give us an idea of growth metrics? For example, on our projections, 1 time, 3 times, 5 times? Is there a ratio that we should follow? Between 1 and 50? Between 1 and 50 times?
I'm not going to comment on that one, because that's not something we follow.
Okay, good. What is it? Is that it?
Yeah, I'll just, maybe from my experience being on the other side of the table.
For sure.
So past is a good predictor of the future, and I know investors might not agree with that, but if you're saying that you're going to do 3x next year, show that you did 3x the year before or 5x before you were earlier, and that's just going to help you. Understand, it's just, you're kind of building trust with someone that you don't know yet, but at least you're able to back it with data. So that would probably be, I would reverse engineer that into what are you currently doing and what's the extension to that in the future, which is realistic.
It's actually what we do as investors in our due diligence process. We'll look at your numbers, where you want to go, and we'll break it down with how many customers you have now, how much are you charging per customer, and what's the capacity for growth, whether it be SaaS and then we'll reverse engineer it anyways. And so if you reverse engineer it for us, and if you have authenticity, I'm always going to come back to this, in that you present an ambitious picture, but a clear one as of today. I think, it's an inexact science. Nobody can predict the future. And so as long as your models hold some truth as how it is today, I think that's, you'll be fine writing up those today.
Just don't show 1 million to 50 million in 3 years.
Yeah.
Like, we adjust those. We know it's not going to happen. So wonderful.
We're actually more brutal to those.
Yeah,
than
exactly.
to the normal.
Yeah, exactly. Because then you question the founder's thought process and, going ahead and presenting that. So
I thought you were gonna say sanity. Yes, we have time for one last question. Go ahead, please.
Yeah, there's obviously a lot of dry capital dry powder that's been raised in the last years. What are some of the market signals that you're tracking that kind of indicate that the tide is turning back to more aggressive fundraising for VCs?
I don't have those signals yet.
So no, I don't have those signals, and actually what I'm hearing from some fund in the US is that they're going to return money to LPs. So what we're starting to see is some funds are saying, in this environment, I've raised $1 billion, I won't be able to spend $1 billion. I prefer to return 200 million, and then in 3-4 years time when I raise again, I know that 200 million is going to be there, because my investors are going to respect the fact that I was truthful and I don't want to be going to do more risk than I need to. So that's more in the US. We're not seeing that in Canada yet, but a lot of US funds are starting to think about returning money to LPs, and that means that huge dry powders that we think there is in the market might actually be smaller than what we're thinking as well.
Do you think that's bigger funds though, like funds that have raised multi-$100 million?
I see it in both, because there's some of the small fund in the US, like the US is not Canada, right?
Yeah.
If we look at Fintech in Canada, how many funds are only 4 funds?
Yeah.
So we start returning
Yeah.
money, there's something we're doing wrong. But in the US, you've got tons of funds, and some of those small funds are unable to get on any appealing deals anymore. So they don't know what to do, and better be off, right, returning 20 out of 80 and then investing 60 and then getting back at 20 later. And those big funds usually have companies that they can support from, because they'll have a waterfall of funds. They'll have the startup, the pre-seed, the seed, the Series A, the Series B, the Series C funds, and they're feeding each other.
Yeah.
And you'll have, so if they have too much money, rather than you doing new one in Series D, they'll just pick back up what they had, even if it's not the best company in the world. They know the company is, and they'll go back. So they have less problem getting through that dry powder. But what we're also seeing is that they're not investing in new companies. They're just keeping their portfolio as is. And that's why we're seeing so low numbers in terms of investments, because it's follow-up rounds that we're also seeing.
That's all the time we have, folks. But thank you so much, Trish. So, well, networking is going to resume now for in-person and online. Come say hi to our great panelists and mingle, get to know each other. It's really nice to see the community get together. So thank you. Thank you, everyone.
Thank you.
Thanks.